Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is July 23rd, quickly wrapping up another month here. We're going to take a look at one out of the industrial sector. We have covered this one on the channel before, but it's been a while and a big drop today, so I thought we'd take a look. A.O. Smith. Let's jump right in. If you have not done so or you are new to the channel, if you could do me a huge favor, hit that thumbs up button down below if you are a dividend growth investor and you find any value in this content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. I do subscriber and viewer requests, so if you have a company like A.O. Smith you'd like me to cover in the Stock Pick of the Day series, go ahead and drop that down below. Do you hear that? If it's a little loud, I'm in my garage and there is a heck of a storm blowing through, so bear with me on this one. Hopefully we don't lose power while I'm trying to record this. And back to everyone, really appreciate everyone who's taking the time to do that. Doing that really does help all of that, the thumbs up, the subscribe, the hitting the notification bell, as well as dropping a comment and watching the videos to the end. That really does help out a small YouTube channel like mine with the YouTube algorithm. Helps to spread the videos a little bit further. Now let's jump back in and look at A.O. Smith a little bit further. This is the Vested Interest Stock Screener. This is how I look at a company on a high level to see if I'm interested in investing. It's also how I do a back check on companies that are in my portfolio to see if they still meet the initial screener. And just because it meets 5 of 8 or 6 of 9 if it's a bank or an insurance company does not mean I'm investing. It just means it goes onto my watch list, and then I do more of a deep dive into the company's financials, look at the balance sheet, the income statement, debt to equity ratios, how's the revenue growing, looking at margins, all the other things you should be looking at if you are investing in individual companies. And if you don't want to do that type of deep dive, you should be staying away from individual companies and investing in index funds and ETFs. And Warren Buffett, who I believe is one of the greatest investors of all time, would tell you to stick to an S&P 500 index fund or ETF. So an ETF like VOO or SPY, which are two that he has in his portfolio. So go check out his 13F and see what else he has in his portfolio. But those would be the two ETFs he would recommend, or he has anyway, something that tracks the S&P 500. Now back to A.O. Smith. You can check them out at their homepage, www.aosmith.com. That's www.aosmith.com. That is their homepage where I pull this information from. Customers look to A.O. Smith for innovative solutions to their water heating needs, a reputation we have enjoyed for 80 years. Today we deliver the world's hot water to residential and commercial customers in more than 60 countries, offering some of the best known and widely respected brands in the industry. Brands deliver long-lasting or reliable service with features our customers value. We also offer the broadest range of high-efficiency water heating products that save energy and save our customers money. And as you can see here, A.O. Smith Innovations, American Water Heater, Aquasana, and if you were to go to their homepage and click over here, you'd find about 12, 13, if not 15 more brands that fall under their hot water heaters and their hot water heater products. Now, the reason we are taking a look at them, down today 9.39%, huge drop on the day, closed out the day at $80.47 per share. We are talking about A.O. Smith Corporation, ticker AOS, out of the industrial sector. Big drop on the day there. 52-week range as low as $64.14, as high as $92.45. Even with the big drop today, they are still leaning towards their 52-week high, and they are not within 15% of a 52-week low, so no check there. Market cap is $11.803 billion, so this would be a small cap company here. A beta of $1.14 billion, so they are a little more volatile than the overall market, and you can see that volatility throughout the day. PE ratio a bit elevated here at 20.9, $20.90 per share. I'd like this to come down, and really I look for companies, 18 or under, preferably lower the better. But this is a little elevated for a company like this. EPS sitting at $3.85 per share. Earnings date July 23rd, so that was today. So I'm assuming they had some negative report out today around their earnings, whether that's forecasted future earnings, whether that's they had a miss on the top or bottom lines. You'd have to check that out. I am not covering that on this video. Just know that they did have earnings released today. Forward dividend is $1.28 paid out on the year. They are quarterly payers, so divide by 4 or just wait, and we'll show you what they are paying per share here. It sounds like the rain's dying down here. Dividend yield of 1.44%, which is a little low, but again, if you were to get them closer to their 52-week low, you might get them closer to a 2% dividend yield. ex-dividend date coming up July 31st. So if you were to buy them now, you would be in line for the next dividend payout. You just want to make sure you buy them July 30th or sooner. Don't wait till the ex-dividend date. Buy the day before or sooner if you're interested. They do pay out on August 15th. 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $89.13 per share. So they do see some upside as far as price appreciation per share here. We're going to jump over to, if you were to go to Yahoo Finance, where I pulled this information from, I'm not affiliated, and you were to go over to the left side of the page, you'd see some tabs. You'd see financials, statistics. We are going to go to the statistics tab and go down to dividends and splits. We're going to look at their 5-year dividend yield average of 1.76, compare it to their current 1.44, or over here where it says forward annual dividend 1.44, same number. And since it is lower than their 5-year average, that speaks to overvaluation. These numbers are inversely correlated. So if this number was higher than their 5-year average, that would speak to undervaluation. In this case, 1.44 being higher than their, or lower than their 5-year average, that speaks to overvaluation on this one. Payout ratio is very low though, at 32.21%. So lots of room to continue to increase that dividend, pay down debt, make acquisitions, reinvest back into the company. We like to see a low payout ratio. I like 75% or lower, so they'd get a check there from me. Now we're going to jump down to free cash flow. We want growing free cash flow over time because typically if a company has growing free cash flow, they have growing dividends to match. So as you can see, going back to 2021 here, $566 million in free cash flow, dropped down in 2022 to $321 million, back up in 2023 to $597 million, and TTM, trailing 12 months, they're saying $573 million, though remember, this trailing 12 months includes numbers from 2023 as well as what has been reported in 2024 now, so we'll have to wait and see how much of this is actually 2023 numbers versus 2024 numbers. But right now, I would not give them a check for growing free cash flow for this dip down here. And this is a cyclical company. Typically, if we're building a lot of houses or things are really good and people have disposable income, they might be in line for buying a new water heater or upgrading to a larger water heater. Or if you're, like I said, doing a lot of building, obviously you need to put water heaters in new houses or new apartments and condos. Repurchase of capital shares, they are repurchasing their own shares pretty consistently, 366 million, 403 million, 306 million. Again, we'll have to wait and see how much of this trailing 12 months is 2023 versus 2024 numbers, but with 327, they looks like they are going to be purchasing some more shares, sir. So I like that. I like to see them repurchasing their own shares. But again, a little bit of cyclicality around this company, so they wouldn't get a check for growing free cash flow here. Now we're going to jump over to stockanalysis.com. This is another source that I go to for information. I always recommend more than one source so you can make sure the information you're getting is accurate and up to date. Sometimes these sites are wrong. Sometimes their information is outdated. Now they have 6 analysts that have taken a look at this. They call it a consensus hold. They don't have an arrow, but they do call it a consensus hold. If you were to go to the stockanalysis.com webpage, you'd be able to click on each one of these: strong sell, sell, hold, buy, strong buy, and see how many of the 6 analysts fall into each category. Now 6 analysts is not a lot of analysts. Usually I like it, 10 or more or 8 or more, somewhere in there. 6 is getting on the low end. You could be considered an analyst if you wanted to do analysis on companies and submit it. So take the analyst's analysis with a grain of salt. Again, you can do your own analysis and kind of figure out what you want to pay and where you think the company is overvalued or undervalued based on the metrics you set that you want to review. And that's the other thing. The analysts don't tell you what their metrics are, right? They could be looking at price to earnings. They could be looking at price to book, PEG ratios. They could be doing discount cash flow analysis. There's all sorts of different ways to judge whether a company is overvalued or undervalued. They could simply be comparing it to other companies in the same sector and saying it's a higher price stock or a lower price stock. You don't know. So don't blindly follow analysts either. Make sure you're doing your own research and setting your own investing criteria, and then you invest based on that. Sometimes it's nice to see what other people think, but it's your investment. Excuse me. Now, they do have a low estimate of $75, which would be a 6.8% decrease from where it currently sits. They have an average estimate of $89.83, which is pretty close to what we saw with Yahoo Finance on the previous page. That would be a 11.63% increase, and a high estimate of $97 would be a 20.54% increase. So I really use these analyst estimates as a range, right? They're saying it could be as low as 75. They're saying it could be as high as 97. So it falls kind of right in the middle of there. Maybe it's fairly priced. Maybe it's still overpriced. Maybe it's underpriced. I would do a discounted cash flow analysis and see what I'm willing to pay, and then that would eliminate some of the fog around what the analysts say. Now we're going to look at statistics here. I like to look at return on invested capital and return on equity, see how well the company is reinvesting its funds back into itself, or making acquisitions, or building out new plants. Whatever they're doing with their capital, it tells you how efficiently they are doing that. And I like 10% or better for these metrics. Return on equity, 30.8%, 3 times what I'm looking for there. Return on invested capital, very nice, 28.65%. Very good numbers overall here. They would definitely get a check there. I like 5% forecasted EPS growth over the next 5 years. They're looking at 9.07, very good number there. And their revenue growth, 4.49%. That's very nice as well, even though it's not necessarily a metric I look for. I do want growing revenue over time, though. So you set your own metric for that one. Let's look at the dividend history as we wrap this one up. They are a quarterly payer. Their payout ratio, again, very low, 33.16%. Now this is wrong. Negative 14.67%. As you can clearly see down here, they have been raising their dividends. So I did look at this before we got on line here. Let me look over here where I wrote it down. Their 5-year dividend growth is actually 17%. Their most recent dividend raise was 7%. So I would go with the 7%. I don't know that I'd go with the 5-year. I usually go year over year. So I would use a 7%. The last time they went from 30 to 32 cents was a 7% raise. Now going back here to April 2022, they were paying 28 cents. January 2023, they raised it up to 30 cents. October of 2023, they raised it again up to 32 cents. Now they've held it steady at 32 cents since then. So I would anticipate if they were going to continue their dividend growth, you would probably see on their October report out for their November payment, they will maybe increase that dividend again to continue that dividend growth. This is just wrong. Growth of years, 31 years, that's right. Buyback yield is 2.44%, so they're efficiently buying back shares. Shareholder yield of 3.88%. They do pay out on the February, May, August, November time frame, and it looks like they may pay some special dividends along the way, because when you see that 2 dividend payouts right there, August 15th and August 15th, 30 cents, either that's a duplicate or they paid out a special dividend there. So very good return of capital overall, and very nice company overall. I just don't like the valuation currently. So let's look at the screener here. Understand the business. That's where we started. Check there. Growing free cash flow. Nope. We had the one down year there. Growing dividend. Yes. Dividend payout ratio of 75% or yes. Yes. Down in the 30% range. So very low. Check valuation based on dividend yield theory. Dividend yield theory says it's potentially overvalued. So no check there. It is not within 15% of a 52-week low. It's not in my portfolio. So no check there. Return on invested capital, return on equity, well over 10%, both around 30%, and earnings per share growth is over 5%. It's actually 9%. It's almost double what I'm looking for. So that's 1, 2, 3, 4, 5. It would make it on my watch list. It is on my watch list. It is one in the industrial sector I do like. I don't know that I like it more than something like Snap-on, but it is an interesting company. We all want hot showers, so again, but it is a cyclical business in nature. Whenever we have a lot of building, they tend to do well. If we have a pullback, I don't know a lot of people that are running out to buy new hot water heaters on a regular basis. It's typically something you buy if you have to buy, or if you buy a new house and need one, right? But again, we all like hot showers. Well, let me know what you think of A.O. Smith. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like A.O. Smith you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down in the comment section below, and make sure that notification bell is rung so that you are notified whenever we put out that video. Now, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in, and we will see you in the next one. I am not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing it. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.